I'm joined today by Pattu from Freefincal. He has been writing and analyzing personal finance and portfolio strategy for many years, and his frameworks around asset allocation and retirement planning have influenced a lot of serious investors in India. So, Pattu, thank you for joining.
Thank you. My pleasure always.
For someone planning to retire in the next 5 to 10 years, what should the asset allocation realistically look like? In the last podcast, also, you said equity allocation should not be beyond 50% and maximum it can be 40%, which I agree. But from now till whatever my retirement age is, let's say it is 45 or 50, how do I keep changing my asset allocation?
Yeah, I think
You
so.
can take any number as the current asset allocation.
So it depends. It depends on how long you've been investing and how much you've been investing for equity and in what portfolio. Everything matters. So if you're talking about a guy who's just waking up and finding out he's only got 10 years to retire or 15 years to retire, that's a different thing. Somebody who's been investing already for 15, 20 years, that's a different thing. But what I think the answer will start with looking at the initial withdrawal rate. That is, you ask yourself, if I retire today, even though my retirement is still 10 years away, if I retire today, I must estimate my annual expenses and divide it by the liquid corpus that I have. So annual expenses divided by the liquid corpus I have. How much is this? And multiplied by 100 to make it into a percentage. That's the initial withdrawal rate. So annual expenses divided by the liquid corpus at hand now, multiplied by 100 gives you a percentage. If this initial withdrawal rate is anything above 5%, 5.5% or so, then it is a big red flag already. It's a red flag that means that the corpus is significantly short and you have two choices. One is you need to invest significantly more than what you're investing. Let's say you're investing 50,000, you probably need to double it or triple it, which may not be possible for most people, obviously. Or you need to lower your lifestyle and extend your retirement age. That's how I view. It's a very simple metric. Use the initial withdrawal rate. Find out if it is above 5%. If it is 4.5, 4%, okay, maybe you're just about okay, you can manage. But you still have to invest regularly, maybe a little more, but you're not such a bad place. But if you're above 5% already when you're 10 years away from retirement, I think you are in a little bit of trouble and you need to, I think you're going to be falling short of your retirement goals and you need to adjust your expectations suitably. If it is much less than 4%, 4.5%, or let's say it's 3%, 3.5%, then you're already on track. Then all you need to do is just keep doing what you're doing, invest what you're doing. Probably you're investing enough, and then you should be home and dry. So it's not a big problem. So look at your initial withdrawal rate. Don't look at it when you're very young, right? When you're in your 20s and all that, don't look at it. Look at it probably after 45ish, when you are in the last decade to retirement, or maybe last 15 years also, it's reasonably okay. But I mean, at least it's a course. I'm not saying somebody with a high withdrawal rate like 5%, 5.5% can never be financially free at 60 or 55 and so on. But I'm saying it's a warning sign. It means that they need to correct more. So it's like being in red, being in amber, or being in green. When you're in amber, the course correction is only a little bit. When you're in less than 5%, it's the course correction is only a little bit. When you're in red, the course correction has to be significant. That's what I'm trying to say.
About the asset allocation, how it should go from now till the time I'm retiring.
Yeah, that's what you
That
asked.
glide path.
So this is the first step. So how much are you going to course correct is the question, right? So
Yes.
if you don't need course correction, your asset allocation is all right. You're probably investing enough in equity, maybe at least 50% in equity. You must have been investing. If your initial withdrawal is greater than 5%, then you probably have not had a equity heavy portfolio. You probably have 30%, 40% of equity with 15 years or 10 years left to retirement. What are you going to do about it? My suggestion is you can't do much. So if you have only 30%, 40% of equity or less, just leave it like that. Don't change much. Focus on investing more, extending your career, reducing your lifestyle. And that's what I would recommend for those in the red. For those in the amber, not much, maybe 10%, 5% changes. And those in the green, they can continue to invest in the same asset allocation. So that's why I'm tying the asset allocation up to the initial withdrawal rate. The initial withdrawal rate tells you that if the initial withdrawal rate is high, that's the only case where you need to really focus on. The others are reasonably okay. If the initial withdrawal rate at the time for the present initial withdrawal rate is high, that means they have not invested enough in equity. That's usually the situation, which means that you can't suddenly ask them to jack it up to 60%. You can't suddenly ask, because then the behavioral things will kick in. If the bear market starts after this, start increasing equity, then it can be a problem. So I would suggest maintain the 30 with 30 is for 40 kind of equity allocation. Maybe don't go beyond 45. If you're having only 20% equity, maybe you can increase it by about 10% or 15%, but not more. Don't go beyond 45, or definitely not beyond 50. For those who have not had that experience prior. That's what.
Okay, thank you. For our viewers, I want you to speak to them so that they understand why do you say 30% equity or 40% equity is the max. I went through a research paper that had 40% equity as the most optimal one. But then I don't really
40% before or after retirement?
after retirement. So in your retirement, 40% is the most optimal. Issue is that again, there will be another version of the same research paper that is going to come and it is going to say that the previous one had some issues. Right. And nothing wrong with that. That's exactly how research works. But then my retirement, my life is not going to be the same way, right? And now I'm
You can't
70,
keep
you're
changing
telling me
based
I
on
need
research.
more.
You can't keep changing your financial plan. Well, people have to get their PhDs. That's why the research keeps changing. You are right. I mean, see, the way I look at it, and the reason why I keep talking about very conservative. I'm now to be very clear, I am talking about before retirement, and I'm talking about guys who have just woken up at 40, woken up at 45. They have only 15 years or 10 years to retire. So the initial withdrawal rate, all that I've said just before, all of that applies to people who have not yet retired, but they are in the last leg of employment. The reason why I say that don't go overboard on equity is two reasons. One is there can be huge drawdowns. We have seen in the past 65% falls from a peak. You can see that if you are going to cop 60% loss in one asset in your portfolio, you can't have too much of it. That would cause a huge dent in your corpus. And the biggest problem for me is, okay, it falls. What if it doesn't recover before you redeem? The falling is one aspect. The recovery is the problem. If the recovery doesn't happen fast enough, the COVID was an exception. It fell down and then it immediately picked up. It was an overcorrection in the bottom side. It was an overcorrection on the top side. Then there was a slow steadiness later and so on. That's a different matter. But I'm saying, what if it falls down and it doesn't? It takes a couple of years to correct, 3 years to correct. You will seriously be in soup. Emotionally, it will be very difficult for you, because the guys who are already 40 plus and who have not invested enough for retirement in their 20s, in their 30s, they don't have that experience. And if they end up getting a bad experience to begin with, they will be in serious strife because they've lost money. They can pull out and push to go to fixed income, but they'll have to cop that loss. And I think that will scar them already. Already they are worried about retirement and scar them. So that's why I'm saying, I think even those who are in, so what I would recommend is those who are on their 30s, 35s, don't exceed beyond 60%. And as you age, start lowering it down well before the goal deadline, well before the retirement deadline. And in the last decade of retirement, if you are below 50%, maybe 45, 40%, that kind of a approximate, then you are comfortable. This is for person who are experienced. But for person who is like waking up at 40, then I would say less than 40 is also fine. 30%, 25%, something like that. Something that is, they can get a little bit, they can taste of the success, but not too much of the risk. That's the kind of sweet. Of course, these numbers that I'm suggesting, they're based on two things. One is, I have run these numbers. I have looked at the risk, but I've looked at it like 10 years ago, 12 years ago. But my thinking has been tempered more by my experience recently than the analysis. So I think there should be a bit of both. So I'm saying you can play it safe if you do it. It's better to play it safe than to fail badly. That's how I view it, the whole thing.
The most difficult thing to actually plot in your retirement plan is your own cognitive ability. The way I think today, the sanity with which I invest, the temperament that I have, I do not know if I'll have that when I'm 65, 70. I do not know if I'll even remember my investments or not. So all of this asset allocation, the planning, everything is based on the fact that I'll have my head on my shoulders. What if I lose it at that time? What is the solution for that?
So I think there are two things here. One is I think we should always have the backup of a SEBI registered fee only advisor. There are two ways to do this. One is tell your spouse, look, if I'm not able to manage my portfolio for some reason at any time, you call this person and you work with them. Or you pay a retainer fee to an advisor and you tell them, look, I will listen to your advice, or I will just pay you a retainer. I will be a DIY. I will manage my portfolio on my own, but I'm paying you a retainer because you know all my investments, you know all the details. You jump in when I'm not able to handle it. So there are two ways to do it. Whether the advisor will accept the retainer or not is a different matter. The way I see it is you can do it. You can be very upfront about it, and you can say, look, there are many people who go to these advisors, fee only, fixed fee, SEBI RIAs, they go to them and say, I'm a DIY guy. I want you to validate the plan. And they will validate it. And most of them, see, they know. And most of them will tell him, do you look, we are mostly on the right path. There's course correction, if any, are very typically very small. Right? When they have the confidence to go and tell somebody they want validation, they wouldn't be backbencher. They would be at least average or above average guys. So if you are a DIY guy and if you have done this retirement planning on your own, you can seek validation, pay the one-time fee, and you keep renewing with the understanding that it is a retainer fee. Basically, they will jump in when you are not. They'll be the substitute. Or you can simply tell your spouse, these are the list of people I have faith in. You contact them if I am not able to handle the corpus at any point in time in my retirement. This is the solution that will work at all decades of retirement, in your 60s, in your 70s, in your 80s, and whatever. However, regardless of how you plan with an advisor, DIY, or paying a retainer and DIY, whatever you plan to do, I think once you hit 70 or once you hit a health scare, and that limits your ability in some way, because people are going to get hit by health scares. Today we have heart attacks in the age of 40s and 30s and so on. So definitely by in the 60s we are going to have all sorts of health scares. So once you hit a health scare or once you cross 70, the management required in your portfolio should significantly drop down, and more of your retirement corpus should be converted into either annuities or fixed income, liquid assets, and very little unmanaged kind of equity, which you know, if it does well, you will use it for a discretionary spends. If it doesn't do well, you will just wait and maybe leave it as a long-term investment. Maybe you leave it as a legacy and whatever kind of thing. So that shift. So you must plan for the shift. So let's say you start with 40% equity at the time of retirement, right? And you're working with an advisor in the background. Either you have the name on a list or you are paying a retainer, whatever. And once you cross your 60s, I think that 40% should stop coming down. It should come down to maybe 30%, whatever, some number that you are comfortable with. And you are shifting to a fixed income corpus. So that there are people who say, look, once you hit 80, all your money should be in your SB account. That is all. SB account with your spouse as a second holder. So like I said in the last video, no, your nominees will thank you if you do this. They don't have to go run pillar to post saying, oh, demat account here, share here, mutual fund here, this one there. Everything you're basically doing this. And you write your will like this, in the sense that instead of saying, you write your will saying, I have 10 mutual funds, 5 mutual funds will go to my first son, second, 4 mutual funds will go to my daughter, and so on. You don't need to do it. Convert it, make them second holders, or shift it to their bank accounts right away, even before you die. Make them second holders in a bank account. You have 2 bank accounts. The first child is a second holder in the first bank account. Your spouse is a second holder in the second bank account, and so on. And then everything is taken care of. After you die, they get the money. It's as simple as that. It's a simple matter of taking the death certificate, going to the bank, and circling out your name in the passbook. The money is theirs. So the will is already done. The estate planning is already done when you are alive. So I think this will take some some kind of planning, I mean, some effort, but it is possible. And definitely you're right, cognitive risk is a very important problem. And I think while people are becoming more and more healthy, people are also becoming more and more sick at the same time. It's a very divergent problem. People are living longer, but people are getting sicker fast, earlier and earlier. So which means that there can be an area where you will live long but not have good quality of life. And when you don't have good quality of life, you cannot be managing your money. So that's why I keep saying, before you buy something, just think. Just think about your nominees a little bit. I'm so, oh, there's this shiny new fund, there's this shiny new stock. Just think, when you die, people have to run around from you doing this and doing that, getting the money from everywhere. So just don't taste everything in a platter. You don't need to do it. Just keep it very simple. And so it's very important to start thinking about that after you do it.
What we say and what is actually done by the investor, these are two different things. Even the investor knows that what I'm doing is probably not right. And that is asset allocation. And I know you have vehemently said that those who care about tax, they'll not be rich, something of that nature, if not those words. So for them, if they tell themselves that, okay, I am going to just limit my funds to two funds, one balanced advantage fund, one multi asset fund, or one aggressive hybrid fund, whichever, and they start just investing in it for the next 2 decades. Is that a bad solution for folks?
See, first of all, I don't think we need to do backflips for people like that. And if you are not disciplined, you're not going to make it. As simple as that. If you don't manage your time, you are in trouble. If you don't invest enough, you are in trouble. If you don't understand risk management, you are in trouble. So the way I see it, you don't have a choice. You have to come around and learn it. People are always asking me, is there a way I can prevent rebalancing? Is there a way I can avoid tax associated with rebalancing? Can I invest in this fund so that it will take it? No, because that fund manager is not working for you. They are working for somebody else. Their risk priorities are different. They're not thinking about you when they are investing. See, I can invest in a hybrid fund. There is no, the way I see it, there is no one fund portfolio. People are always saying, this one fund, I will invest in one fund. I will not touch it. Everything is fixed, taken care of me. There's no such thing. It doesn't exist. All you need is SEBI to come up with a different rule. All you need is the AMC to come up with a, what is it called, change of strategy addendum or something like that. There's a circular and they'll change strategy just like that. They will add something else. They will suddenly add silver to it. Suddenly add rates to it. Everything can change. So there's no one fund that will solve your problem. You must have a portfolio where you can control the risk. Because in a hybrid fund, you don't control the risk. Hybrid funds are excellent. For example, if you take aggressive hybrid fund, they are my favorite kind of hybrid funds. But I treat them as 100% equity. Because if you look at the volatility is significantly lower compared to 100% equity. However, it is still in the equity regime. The volatility is it is still an equity fund in terms of volatility. You can't say that I've suddenly added 30% of bonds and the risk I get is like that of a debt fund. No, it is still an equity fund in terms of risk. The returns are still like an equity fund. So I still must have separate fixed income in addition to that uh, aggressive hybrid fund. So I don't think that strategy works, and I think it's a very childish idea to say that I can avoid rebalancing, I can avoid my responsibilities, I can just invest in one fund and do that. I think that's wrong, and it will be very short-lived. That's how I view it.
If I'm retiring today, let's say with 3 crores, whether it is enough or not, that's a separate discussion. How would you deploy that practically across all these three buckets, safety, income, and growth? And while explaining that, if you can also touch upon the bucket strategy that you talk about.
Yeah. So again, it all boils down to the initial withdrawal rate. Again, so the guy is going to retire, and I have some. It doesn't matter whether you have 10 crores or 1 crore. It doesn't matter because whether it is sufficient or not depends on your lifestyle. So the initial withdrawal rate matters. Again, to reiterate, the initial withdrawal rate is your annual expenses at the time of retirement divided by the liquid corpus that you have at the time of retirement into 100, expressed as a percentage. And if this is anything above 4.5%, then most of your money, I would recommend, should be in fixed income assets. You cannot do much of a bucket strategy there. You cannot afford to try and beat inflation. That's what I would recommend. And anything between 3.5% to 4.5% of initial withdrawal rate. There's a percent kind of bandwidth there. That is a slightly grayish area where you need to take into account the experience of the retiree. How experienced is this person in handling equity market downturns? How much do they understand about the bond market? How much do they understand about gold, if necessary, and so on? And then design a portfolio where they don't probably cross 20%, 25% of equity, not more than that. Approximately. That's what I would recommend. And even that, in my opinion, is a risk which has to be taken with with proper information, and probably a little bit of lifestyle trimming is also probably necessary. Lifestyle trimming is also significantly necessary if the withdrawal rate is greater than 4.5%. The initial withdrawal rate is greater than 4.5%. But for those with a withdrawal rate 3.5% or lower, they are the ones who can actually afford to have a proper bucket strategy. The usual bucket strategy in the usual sense. Of course, the guys with the greater than 3.5%, less than 4.5%, they will also have some kind of buckets. They can put the money in different buckets of different risk, but mostly in fixed income. Same is true for greater than 4.4%. But the conventional bucket strategy that we talk about in DIY circles, I think that applies only to people with a initial withdrawal rate of 3.5% or lower. Only they can afford to try and beat inflation in retirement. Only they can afford to hold maybe 40%, maybe 45% in equity, depending on their initial withdrawal rate. For example, somebody has a 1% withdrawal rate, that is super good, right? Somebody, then I can fund the retirement entirely with my fixed income assets. The retirement can be my equity can be just for discretionary or for legacy and whatever. So that is all fine. But for the typical case, 3.5%, 3%, I would recommend 40, maybe 45%, regardless of whether you are an early retiree or a normal retiree. There is this logic that says, oh, I'm going to retire by 45. I can take on 60% equity. No, you cannot. It's all the more reason not to take on 60% equity. You should be a little more conservative because you don't want to write up your biodata again, right? Once you're retired, you're retired. So there also, I would recommend having 3 or 4 buckets. In these 3 or 4 buckets, I must guarantee myself that if there is a bad sequence of returns or poor return sequence from the equity market, a very prolonged bear market, which I have been talking about, if that happens at the start of my retirement, and if I am not taken into account asset allocation properly, then I run the serious risk of depleting my corpus before my lifetime. Therefore, my income bucket, I would recommend, has got 15 years of solid, safe income indexed to inflation. It is inflation protected income for the first 15 years of retirement. So that gives me a 15-year runway in which the other buckets can grow. So my income bucket has got no equity, has got only safe fixed income, and that guarantees me return income, inflation indexed income for the first 15 years of retirement. So if I retire at 60 up to 75, I am more or less comfortable. Remaining buckets can have this 40% equity and 60% fixed income in that. And they can be deployed sequentially, one after the other. Once the 15 years bucket, 15 years are up, you can take the middle bucket and convert that into income and use it. And you can use the last bucket, or you can progressively, like I said, talking about cognitive risk. After 15 years of retirement, you can start converting, liquidating it from equity to fixed income. You can play it in different ways. See, bucket strategy, there is no one way to do it. There are multiple ways to do it. But the basic essence of a bucket strategy is your investing in imaginary buckets. The buckets are not like, they are not some actual buckets, right? Actual buckets means um, actual compartments. They're not actual compartments. They're only in your head, but you are layering the risk such that you take care of the first 15 years of retirement, guaranteed peace of mind. No matter what happens in the equity market, I will not go back to work until I'm 75, and I'm giving 15 years for the remaining buckets to grow, and then I convert them to income. So this is one way to deploy buckets. There are multiple ways to deploy buckets, and I mean there are different ideas and so on.
Yeah. So the one of the questions that could be is why 15 years? Why not 5, 7 years, 10 years, etc. Why
So
15 years?
I'm thinking of a lost decade here. I think the biggest problems that we are going to face going forward is, one is political uncertainty that can happen at any time. You don't have a majority in the center. You are going to be in trouble. The markets are going to become very, very turbulent. You know what happened on the Lok Sabha counting day. So that can, if that continues, we are in serious trouble. And the second is climate climate changes, extreme weather events. I think that can cause damage to how the way our businesses work and so on. So I think I would like to give 15 years just to be on the safe, absolutely safe side, saying 10 years for a lost decade and a little bit more for recovery. I'd say I can handle a 15-year bear market. That's, or at least a 10-year bear market. Of course, you can tweak it. You can say, yeah, 10 years is enough, 7 years is enough. But this is my ultimate, I'm talking about the ultimate safe retirement plan. Of course, this is not the ultimate safe retirement plan, because William Sharp, who is a Nobel laureate, William Sharp, he has a retirement income ebook. And he says, if you are going to spend 30 years in retirement, then you should have 30 buckets in your retirement strategy. That's a little extreme. But he says that way you are completely safe, completely secure. So compared to that, I'm only talking about 3 buckets or maybe 4 buckets. But even then, the point is I'm guaranteed that I have safe income for 15 years, inflation index, reasonably inflation indexed income. The reason why I prefer this instead of doing back tests. See, I have done back tests. I have done back tests for Indian data as far back as 2012. I have done all the back tests, withdrawal rates, etc., and so on. I'm not a big fan of them because you don't know how the future is. The Indian market is continuously changing. In the 90s, it was one kind of market. In the 2000s, it was different. In the 2010s, it was different. It is changing. It is learning. It is progressing. Nobody knows what the next decade in the stock market will be. We don't know whether it will be a complete flop or it will be a super duper. The assumption that just because India will become the third biggest economy, if it has not already become, or India will become an economic superpower in the future, will mean better equity is a very simplistic assumption, and that such a one-to-one correspondence will not happen in the market. Economic growth and equity returns are not directly linked. Just because you look at the GDP over 15 years and it has grown, doesn't mean in that 15-year period you will make money. Because market is ultimately decided by demand and supply forces, buy and sell forces. And that has got on a day-to-day basis, they don't care about the GDP and so on. They are looking at news. They will react to the next 3 months news, next 4 months news, and they will always overreact and either overbuy or sell too much. So they're going to do all that sort of thing. So there's no one-to-one correspondence. So you must have a proper risk management strategy. And I'm not a big fan of the backtesting because the data is very limited. And I'm also not a big fan of the Monte Carlo simulations which are being done, because the Monte Carlo simulations, uh, to give you a common example I give, if you look at the COVID era market crash, the market crashed by 35% or so, and then it immediately zoomed up by 90%. I can argue that if the 35% crash had not occurred, the subsequent 90% gain would not have come in. I would have not got that 90% gain if the market had not crashed by 30%. I argue that the 35% fall caused that overcorrection to go up like that. So in the Monte Carlo simulation, they will jumble up the returns. They will put the 90% before the minus 35%, which in my opinion does not make sense. It okay, for a simplistic idea, it gives you to understand retirement planning, you can use Monte Carlo simulations, but you can't do any serious individual financial plans with it. I think the best way to do financial planning is to be very, very conservative. If you fall from the first floor, you can get away with a broken bone. If you fall from the fifth floor, you are gone. So keep your expectations lower, and therefore you can handle disappointments better. And if you keep your expectations lower, even a small win will look like a big win. If you expect 10% and get 11%, 11.5%, you'll feel like a king. But if you expect 14% and get 12%, you are going to be a big loser. So you don't want to be like that.
I'm sure people are going to love that. My personal take is you should have a minimum of 10% of your retirement corpus as a medical corpus. So it continues to increase. Like you can have it 50%. That's good. But again, you have so many goals and money is limited. So how much do you think is the minimum that one should have?
It's very hard to say because the number of ways you can get sick and the number of ways you can die are literally like a million. So you don't know. I mean, every time you're learning about new syndromes, new diseases, and so on. When something hits our relatives or when it hits us. For example, I have an autoimmune condition called myasthenia gravis. I never heard of myasthenia gravis until it happened to me. Right. So that's how it is. So you cannot predict how much money you need for hospitalizations and so on. So what I would suggest to people is don't stress too much about what should be the corpus needed. Always push yourself to invest more. So when you do the retirement planning, do it without the allocation of a separate medical corpus or anything. Just do it for your essential expenses. And if the math says you have to invest more, push yourself to invest 12,000. Let's say if the math says 10,000, you have to invest. Push yourself to invest 10,000. Push yourself to invest 15,000. And keep pushing yourself continuously so that the extra amount with the growth that you will get from your investments will end up resulting in a sizable corpus at the end of the retirement. And you can use that part of a corpus as for medical emergencies as you need. And you must also never ever forget to take in the medical insurance premium as an essential expense when you do your retirement. So you need to have the medical insurance taken in, and you must recognize that medical insurance will increase at least 10% or 12% on average over a decade. So that would mean it will not be linear. So it'll be flat for a couple of years. Suddenly the insurer will lose a lot of money and they'll increase it by 300%. So that's the practical way it will work. But on average, over 10 years, 15 years, and 20 years, you must expect a 10 to 15% year on year increase in premium and factor that into your retirement. So it's not easy to do. If we do that, if we invest a little bit extra, okay, if it's 500 rupees extra, fine, whatever. Invest a little bit extra and take into account health insurance premiums properly. I think we should be reasonably set for a separate medical corpus. If you are going to say 10% is going to be your corpus, you can set it like that, but it has to be set at the time of starting your retirement planning, because you can't set it later because it'll be too difficult for you to catch up, which is my reason I'm saying it's be more practical for you to keep investing more and you will get an excess. For example, you are financially independent and you ask yourself, ignoring the medical corpus, what is my corpus necessary today? And if there is a excess, your actual corpus is, let's say, 10 crores, and your corpus that you need for safe retirement is, let's say, 8 crores. The 2 crores is set aside mentally in your mind as a emergency corpus, including for medicines, in medical emergencies. So that is one way to practically do it. I don't want to commit to a 10% or 20% because I don't think it is practically possible to do that. What is more practical is for people to slightly push themselves every month to invest more and more and more and more, so that you end up getting the 10% or 15% extra, taken into account the growth at the end of retirement.
Okay. Yeah. Do annuities play a meaningful role in Indian retirement, or are they mostly inefficient?
Absolutely, they play a big role. I think pension should be one component of a retirement basket. I think the retirement basket should have pension. It should have dividend income. I'm talking about the ideal one. Not everybody will have it. Dividend income, pension, maybe some rental income, if at all possible. And then you have some kind of active income, little bit, some minor activities here and there. And then, of course, your main corpus. So it should have all sorts of different layers. And pension is a very important layer because whatever happens in the markets, whatever happens to you, your family will get that much pension for sure. You're guaranteed of that. Forget the tax. You don't worry about all that. You just buy yourself a nice pension plan, or if the interest rates are favorable and if you are a little bit savvy, you can go to the RBI retail direct portal and buy yourself a 30-year bond or a 25-year bond or maybe even a 50-year bond with your spouse as your partner, as your second account holder, and that gives you guaranteed income much better than the annuities, sometimes much better than the annuities. The other option is to buy an annuity, and that takes into account, that answers the cognitive risk also. Buy an annuity every 10 years. You buy an annuity for some amount of your expenses at 60. At 70%, at age 70, you buy another annuity. That takes into account some more of your expenses, and you're going to get a much favorable interest rate at 70, because the insurer is going to expecting you to die soon, so they will offer you a better return. So you can do that. You can have layered annuities or stepwise annuities and so on. So there are different ways to do it. I'm definitely sure that annuities play a very big role. So when people say that 40% annuity in NPS or the 20% annuity is NPS is a bad thing, no, it's not a bad thing. That is not the problem with NPS at all. NPS are different problems are different in NPS. Liquidity is the problem in NPS. The annuity is essential component, and I think everybody will, once they grow older, they will appreciate the need for guaranteeing some portion of the retirement income for life.
What is the biggest blind spot that you see in retirement planning, other than what we covered in the beginning? If there is anything else that you want to call out.
Things not going to plan. That is always the blind spot, which is why you need to do the retirement review every year. You cannot assume that everything will work well, equity will beat inflation, I will get good returns from mutual funds, I'll get good returns from index funds. No, if something goes wrong, we must have the maturity to accept that something has gone wrong. We must course correct logically and maybe shift to fixed income, maybe shift to a different asset, whatever. That's down the line. But it depends on so many factors. I mean, how much time you have, what is happening in the market. So that is why we should review every year, reassess inflation estimates, reassess return expectations every year based on what's happening, and do the calculation again. It's going to take a minute to do it. So you just need to put in fresh inputs, see where the goalposts are changing. Because if you don't do that, then you will be caught unawares, and that's not a place you want to be in.
Thank you. But it has been wonderful speaking with you, talking to you. Thanks a lot for joining and participating in this discussion.
My pleasure. Always my pleasure. Thank you.
And this video is for educational purpose. Please do consult a registered financial advisor before making any kind of investment or financial decisions. Thank you and have a blessed day ahead.